Let's talk about US government debt, the world's most popular IOU. These bonds are the backbone of the global financial system, trusted by investors and governments everywhere. When countries buy US debt, they're not just investing, they're making a statement about who they trust and where they see the world heading. For years, China was the top foreign buyer of US Treasury bonds, second only to America itself. This massive investment gave China both financial security and a bit of leverage over the US, making it a key player in the world's economic balance. But now China is quietly selling off its US debt, dropping to third place for the first time since 2009. This isn't just a minor adjustment, it's a major retreat that's sending ripples through global markets and raising eyebrows among economists. Their holdings have shrunk to $756 billion, a dramatic shift with global implications. This reduction signals a change in China's strategy, possibly reflecting concerns about US policy, rising tensions, or a desire to diversify its reserves. So, who's stepped up? The United Kingdom. While China steps back, the UK is moving forward, eager to fill the gap and strengthen its financial ties with the US. The UK now holds a record $809 billion in US debt, overtaking China for the first time ever. This is a historic moment, reflecting London's growing influence in global finance and its confidence in the US economy. While China backs away, the UK is diving in, signaling a major shift in global alliances. This isn't just about money, it's about trust, strategy, and the future direction of international partnerships. Japan still holds the top spot, with even more US debt than the UK or China. But the real story is this dramatic reversal between China and the UK, which could reshape the financial landscape for years to come. This isn't just about numbers, it's about power, trust, and the future of money. Every shift in these holdings reflects deeper anxieties and ambitions among the world's biggest economies. Why is China pulling back? Is it a warning sign, a strategic move, or simply a response to changing global risks? The answer could have far-reaching consequences. Why is the UK buying more? Is it a bet on America's future, or a play to boost its own global standing after Brexit? The motivations are complex, but the impact is clear. These moves reveal deep anxieties and ambitions shaping the world economy. Behind every trade, there's a story of risk, opportunity, and shifting power. The stage is set for a new financial drama, and the next act is about to begin. As the world watches, the balance of power is shifting, so stay tuned. Why is China selling US debt? It's a question that's making headlines and raising eyebrows in financial circles around the world. For years, China was one of the largest foreign holders of US Treasury bonds. But now, that's changing. And fast. It's not a whim, it's about risk. China's leaders are watching global markets closely, and they see warning signs flashing. The world's economic landscape is shifting, and China doesn't want to be caught off guard. With US national debt soaring past $36 trillion, China fears America might just print more money, devaluing the dollar and their investment. The more dollars in circulation, the less each one is worth, and that's a big problem for anyone holding US debt. China is also reducing its dependence on the US dollar, a process called de-dollarization. This means shifting away from the dollar in trade, finance, and reserves, and building up alternatives. By selling treasuries, they're diversifying into gold, strategic resources, and strengthening the yuan. Gold and other assets are seen as safer bets in uncertain times, and China wants to be prepared for any shocks. They want more control and less vulnerability to US policy shifts. If the US changes its interest rates or imposes sanctions, China doesn't want to be left exposed or at the mercy of foreign decisions. There's also a practical side. China needs cash to support its own economy and stabilize the yuan. As growth slows and challenges mount at home, having liquid assets is crucial. Selling US bonds gives them dollars to defend their currency during economic slowdowns. It's a financial safety net, allowing China to intervene in currency markets if needed. It's less about attacking the US, more about protecting themselves. China is acting out of caution, not aggression, as it navigates a complex global economy. China is making a calculated, gradual exit, avoiding panic but sending a clear message. They're signaling to the world that they're rethinking old strategies and preparing for new realities. Holding vast sums of US debt just isn't the safe bet it used to be. For China, it's about adapting, staying resilient, and making sure their financial future is in their own hands. This isn't just economics, it's geopolitics. US-China relations are tense, and that tension is spilling into finance. Trade wars, tech disputes, and military standoffs have eroded trust. The US freezing Russia's reserves after Ukraine was a wake-up call for China. They realized their US assets could be frozen too, so selling treasuries is like buying insurance against sanctions. China is also leading the BRICS plus bloc, pushing for trade in local currencies and even a new common currency to bypass the dollar. The US threatening new tariffs on BRICS plus only accelerates this shift. China's move is part of a global push for a multipolar financial world. When China sells US bonds, it's a strategic move on a much bigger chessboard. It's a quiet declaration of independence, forcing everyone to rethink money and power. Enter Bitcoin, the digital wildcard in this global drama. For centuries, gold was the go-to safe haven. Now Bitcoin offers a digital alternative. Bitcoin isn't controlled by any government or central bank. It's global, neutral, and immune to political manipulation. That's why it's gaining attention from those worried about currency devaluation or asset freezes. Bitcoin is accessible to anyone, anywhere, and its rules are set by code, not politicians. As trust in traditional currencies wavers, Bitcoin is being taken seriously as digital gold. The cracks in the old system are showing, and Bitcoin is now part of the global money conversation. The future of finance may be more digital than we ever imagined. So what sets Bitcoin apart? Let's break it down. First, Bitcoin is decentralized. No CEO, no headquarters, no government in charge. It runs on a global network, making it nearly impossible to shut down or censor. Second, its supply is capped at 21 million coins, no printing more on a whim. This built-in scarcity makes it a hedge against inflation, like digital gold. Bitcoin is also permissionless. Anyone with internet can use it, no bank account or ID required. Transactions are irreversible and censorship-resistant, making it valuable in unstable or oppressive regimes. Bitcoin is both a payment network and an asset. It allows fast, borderless transfers, but for most big investors, it's about storing wealth. These features, decentralization, scarcity, and censorship resistance, make Bitcoin fundamentally different from any money we've seen before. That's why it's attracting so much attention. The world is watching. Bitcoin was once dismissed as a fad or a tool for criminals. Now it's being embraced by Wall Street and major institutions. The launch of spot Bitcoin ETFs made investing easy for everyone, fueling a surge in demand and legitimacy. As of July 2025, Bitcoin trades above $117,000, a sign of growing mainstream acceptance. Investors see it as digital gold, portable, divisible, and a hedge against inflation. Even financial leaders now view Bitcoin as a complement to gold, not just a competitor. As more institutions buy in, Bitcoin's price and legitimacy rise, creating a powerful feedback loop. Its volatility remains, but its role in global finance is now impossible to ignore. Bitcoin has crossed into the mainstream. Can Bitcoin really challenge the US dollar? Opinions are split. Some, like BlackRock's CEO Larry Fink, see Bitcoin's decentralization and global reach as a real threat to dollar dominance. They argue that a neutral, scarce, digital asset is a logical alternative as trust in fiat currencies erodes. But critics point to Bitcoin's wild price swings and technical limitations. Governments, especially the US, won't give up monetary control easily. The US faces a paradox, wanting to lead in crypto innovation but also protect the dollar's supremacy. The regulatory future for Bitcoin is uncertain, and a clash with state interests may be inevitable. Some see Bitcoin's rise as unstoppable. Others see it as doomed to fail against government power. The only certainty? The debate is just beginning. The future of money is up for grabs. China's US debt sell-off and Bitcoin's rise are part of a bigger trend: de-dollarization. Around the world, nations are rethinking their dependence on the US dollar, which has dominated global trade and finance for decades. This shift is not just about economics, it's about power, influence, and the desire for greater independence in a rapidly changing world. More countries want to reduce their reliance on the US dollar and its political risks. They're seeking ways to protect themselves from sudden policy changes, sanctions, and the ripple effects of US economic decisions. For many, the dollar's dominance feels like a vulnerability rather than a strength. The BRICS Plus alliance is leading the charge, exploring new currencies and payment systems to bypass the dollar. These countries are developing alternatives, regional payment networks, digital currencies, and direct trade agreements to assert more control over their own economies. Sanctions on Russia showed how powerful and risky the dollar system can be. When the US and its allies froze Russian assets, it sent a clear message: access to the dollar is not guaranteed. This has made other countries rethink their strategies and look for ways to insulate themselves from similar risks. Yet traditional allies like Japan and the UK are still buying US debt, keeping the old system afloat. Their trust in the dollar remains strong, and for now, they see it as the safest bet in an uncertain world. But even among allies, there are quiet discussions about diversifying reserves and preparing for change. The world is splitting, some double down on the dollar, others build alternatives. This divide is reshaping alliances and creating new opportunities for innovation in global finance. This fractured landscape is fertile ground for Bitcoin, offering a neutral option outside both US and China-led systems. As a decentralized digital currency, Bitcoin appeals to those seeking freedom from traditional financial controls and the influence of any single nation. Whether Bitcoin can truly fill that role is uncertain, but its very existence changes the game. It forces governments, banks, and investors to rethink what money can be and how value can move across borders. The demand for new kinds of money is growing. From digital wallets to central bank digital currencies, innovation is accelerating as people and nations search for alternatives that better fit their needs. The global financial order is shifting before our eyes. As old certainties fade, the race to define the future of money is just beginning. We're at a crossroads in the history of money. The US dollar's dominance faces its biggest challenge yet, not from a single rival, but from global shifts and new technology. China's retreat from US debt signals doubt in the old system, while the UK's buying shows the old guard isn't done yet. Bitcoin offers a radical alternative, decentralized, global, and politically neutral. Major institutions are taking it seriously, but risks remain: volatility, regulation, and technical limits. There's no guarantee Bitcoin will succeed, and the dollar's grip is still strong. The future may hold multiple reserve currencies, with gold and Bitcoin playing bigger roles. Today's shifts are early tremors of a possible financial earthquake. Understanding these forces is essential for navigating what comes next. The world of money is changing, fast. Are you ready?